Okay. Did it work? Okay, says we're live. Says we are live. I don't know about that. Let me get the link to this stream here. If I can find it. Good evening, welcome. This is Patrick and you are trading with Prime. There, we got some viewers. Okay. You guys don't want to know what I just had to go through to get this to work. Okay, mic check. Okay. Let me pull something up real quick on YouTube. Okay, cool. We have people in here. Hopefully the rest of the people, let's see, I don't see any live feed. Okay, hopefully we get this feed issue worked out. This is really funny. Awesome, works. I'm glad that all worked out. Yeah, I guess normally what I do is I have it set to I have it set to private because the normal videos that I put out throughout the week are, I want them to have time to load, and so I want the HD to load, so I set it as private at first, and then I let some hours pass, and then I'll go ahead and hit public. Give me 1 second. Okay. Can you guys hear me? Am I too loud, too quiet? Awesome. Thank you for adding that link in the chat. Yeah, and the other thing too is if a link is broken or whatnot, we could always hit the well, in this case it wouldn't have worked because I had it set to private, but we can hit the subscription button and then bell notifications. But of course, in this case, I was on private anyway, so people wouldn't get the memo. So I'm going to go straight into it, and then what we'll do is people who are watching this video later on, you're going to have to, maybe later on I'll go ahead and add different parts to in the description that will give you an idea of what part of the video, if you are a professional options trader or if you are new to options trading, you might want to skip some of the parts. This options course is going to be a beginning course / intermediate. We did a poll, and how's it going, Philly? We did a poll in the Discord, and for those of you who are not a part of our Discord, it's Ride the Bull. The link is in the description. Feel free to check it out. Right now it is free. Pretty soon we will be going premium. Anyone who is not in the Discord, if you're not in there ahead of time, it might cost a little bit of money. Okay, let's get into it. So here's the thing. I don't want to, for the people who are watching this video later on, I know this video course is supposed to be for people who are actually here and present. So what we're going to do is I'm going to run through it, right? And then as we go, if you have any questions, post your questions either in Discord or post them in the comment section. Post them in the comment section. And what we're going to do is I prefer to have Super go ahead and, or if anyone else in the comment section knows the answer to the question, feel free to answer the person's question, because I don't want to stop throughout the video to answer questions, except at the end of the video, maybe we'll go back and look at some of the questions so that, you know, and that's kind of the purpose in this is to help traders out when you're doing these options plays. It'll help you out a little bit. And so that's kind of the principle behind what we're doing here. So I'm going to run through it. Disclaimer, and I don't want to bore you guys. I'm not just going to go through text. We're going to go to the charts and everything. I just want you to, this is my script. You're going to be seeing what I'm going to be seeing because it's, you know, I've got one screen for this and another screen for the OBS. So here's the thing. My disclaimer is this, and it's not as professional, but options trading is extremely risky. We're going to get into the risks. We're going to get into some of the rewards. If you go into the Discord or if you're a part of anybody's alert system service package and they post plays, especially regarding options, if you don't know what you are doing and you don't know how to play the options, how they're designed to play, you could lose a lot of money. And if you're in the group, go ahead and right now, of all of you guys who are in it right now, I want to see how many people. Give me a number one. Put number one in the comment section if you're profitable with options. Give me a number two if you consistently, well, I don't want to say consistently, but if you lose money, give me a number two in the comment section just so I can see who I'm talking to. For those of you at home watching this video later on, you know, there's a lot of risk associated with it. So that's my disclaimer. It's not designed, alerts are not designed for people to just take the trade. Maybe some people advertise them as that, but there's a lot of variables around that idea of alerts. And so if you don't know how to trade options, it's best to stick with stocks. Awesome. I'm getting some replies already. And if you guys, if I'm yelling too loud or if I'm talking too quiet, go ahead and let me know and I will move the mic away, or I'll try to mess with the audio, but I really don't want to because it took a long time to set up. 3. Hey, thanks, James. Good to see you here. 3 has never traded them. Awesome. Perfect. So let's do this. First thing I want to talk to you guys about is, awesome, I'm getting some 3s, I'm getting some 1s, some 2s. So we have a mixed bag here. That's awesome. This is America, right? So awesome. So here's the thing is and we all come from all walks of life, and so I hope if I'm speaking too fast or whatever, just let me know to slow down, and I really want you guys to get this. I want the communication to be on point with the mic volume and everything. Okay, that's my disclaimer, right? Next thing I want to do is I want to talk to you guys a little bit about foundation. And yes, we're going to get into the corny slide, so, you know, bear with me. So here's the deal. Think of options or anything else in the market like this. If we're in the process of building a house, and I don't know how many people have worked in the construction industry. How's it going, Super? And I don't know if you're in here, Super, but I want you to answer questions if people have questions, or anyone else that has questions and know the answer to the questions. I'd like those to be asked and answered in the comment section if you can. If not, we'll address them. When you're building a house, you have to ask yourself, do I want to build... Think of the house itself as your financial dreams and goals and everything you want out of life. Think of that house as your baby, right? Options are not our babies, and I don't ever want to compare them to that. You know, the idea here is our financial insecurities or our financial securities. And that all starts with foundation, right? So I'm going to have this corny picture on here because I want to talk to you for a minute about, does our trading plan involve, does it involve just option trades, or do we have stocks in our portfolios? Do we have a long-term account? Do we have a a way to look at it in the future and say, you know what, this is my wealth, this is my nest egg, this is what I want to build? If you are trading options as if the options are your entire nest, it's not going to be very lucrative over the course of 20 or 30 or 40 years. I'm not saying it's not possible. What I'm saying is, if you're trading your 100% of your account balance and you're trading that 100% in options, it's a very risky way to trade, and not a lot of people are successful at it. But if you have stocks that don't have an expiration date, stocks are the foundation to the financial wealth, and that options are the caveat. They're added on to that. They complement the stocks, if that makes sense. Okay, moving on. I don't want to get too wrapped up into that. An option contract is defined as a promise which meets the requirements for the formation of a contract and limits the promisor's power to revoke an offer. Don't worry. Hey, you know what? I've got a picture for everything here. Think of it like this. An options contract is an agreement between a buyer and a seller that gives the purchaser of the option, the person buying the call or the person buying the put, a right but not an obligation, okay, to buy or sell a particular asset at a later date. This is what differs options from stocks, is that options have a strike price, and they also have time that's associated with the contract themselves, which is why they can be extremely lucrative, but they can also be extremely risky. Don't mind my little pen thing. I'm moving them out of the way here. Awesome. A call. And you know what? You guys might end up rewinding this and going back and re-looking at this too. So a call is the right to buy shares at a strike price at or before expiration date. We're going to talk about that in a minute. This might get overwhelming for those of you who have never traded options. Those of you who play with options, it's going to get boring here for a minute. There's also what's called the exercise, and that is that the buyer, the person who bought the call or bought the put, can exercise the contract at or before the date. Put, the right to sell shares at a strike price. Assignment. The assignment, option seller has obligation to fulfill order of contract if assigned. And by the way, for assignment, a lot of people get like kind of scared about that assignment issue. If assignment is a random thing, it's not like you purchased your option from somebody else and that person is going to force you. There's a process, and we're not going to get into it, but there's a process of assignment, and it's more like a lottery system. Premium, the amount paid for the position. Buyer, the right to exercise the contract but not obligated to. Seller, obligated to fill the order if a buyer exercises the contract, if you are assigned. Do I have a photo on that? Oh, let's get into this. Now you see these pop up in the Discord, right? We don't put the buy or sell because mainly we're buying options. I'll get into the selling part of it in a minute, but we're not buying them usually. And we wouldn't post an alert to sell an option unless it's a spread. Hi, Mirza. Yeah, it will be available on this channel. Absolutely. Quantity of number of contracts. The symbol, in this case, it's Apple. Okay. The date, which is March 12th. Excuse me. The date, which is March 12th. Actually, that would be the year. Strike price. And by the way, this says month in which you bought the contract. This isn't true. And year you bought it. That's not also true. What we're referring to is the day it expires, not when you bought it. I don't know why it says that. Strike price is the price that it's, we'll get into strike price. Which strategy you decide, a call or a put. In this case, it was a call. At how much you pay per contract. We won't get into that. but we could get into that. We won't get into that. Okay. So I'm going to go straight into it. And first I want to do this. We talked about call, put, premium, buyer. I'm going to go into the chart here. Doesn't, by the way, side note, doesn't this look like it wants to break out? Little S&P 500. It's getting ready to. That's what it looks like it's doing. So let's go into here. In your charts, I'm not going to go into the actual... I use Thinkorswim for analysis and trading. Here's the thing, though. You could go into... Everyone has something different. So for purposes of this video, I'm not going to get into how to do certain things within Thinkorswim. That could take a lot more time. And frankly, there are a lot of videos on how to do certain things in Thinkorswim. So far we talked about what you're paying for the option contract. And you see right here, you have bid and ask, right? So if I was going to buy a contract around this price, this is the bid, this is the ask. So let's say, and we're going to get into intrinsic and extrinsic value. But so far, as far as the premium you pay, you're paying $1.77, and it's got a 100 multiplier because every option contract has 100. It's represented by 100. So you're talking about a movement, 100 shares multiplied by this price of $1.77. So let's go back into our... Well, so far as this is calls are on the left-hand side of your screen. The puts are on your right-hand side of the screen. We're going to get into the Greeks in a second. I'm not going to get too in-depth with the Greeks. How many of you guys know a lot about the Greeks? Give me a 1 for I know a lot, or 2 for I don't know a lot. And meanwhile, we're going to go back to my little script here. So calls on the left, puts on the right. Premium. Premium is the amount paid for the option, which can fluctuate depending on how volatile and how close we are to expiration. How much intrinsic and extrinsic value, which I'll get into in a second. Buyer has the right to exercise the contract, but not obligation to do so. Seller is obligated to fill the order if a buyer exercises the contract, if assigned. I think I probably just went over that. Now I'm going to get into intrinsic value. Awesome. 1, 1, 2, 2, 2, 2. Cool. Intrinsic value. How many of you guys, give me a 1 if you know what intrinsic value is, a 2 if you don't, or 1 if you know what intrinsic is versus extrinsic. Give me a 2 if you have no idea. The money, intrinsic value is the money to be made if the option is closed this moment. So let's just say I'm trading an option right now. Let's say I'm trading this SPY, and by the way, here's the strike price over here in this column. These are all the strikes. This is the expirations. If I'm trading an options, let's say I purchase this at the ask. Let's say I purchased this for $1.80, which would have a multiplier of 100, so it'd be $180. And this is the August 21st. So let's say, for instance, I purchased this $180. So the extrinsic value, well, the intrinsic value is only for options that are in the money. Awesome. Got a bunch of replies here. Awesome. Intrinsic value is if an option was closed right this minute and somebody exercised it, how much would it really be worth, right? Minus, so intrinsic value, and I'm going to get into what exactly makes up the intrinsic and extrinsic, but think of it like that. And so the reason why you don't see intrinsic value and out of the money, which we're going to get into also, these are out of the money. The reason why you don't see value in them is because there isn't any intrinsic value. When somebody closes when somebody exercises an option, when the buyer exercises the option contract, it loses all of you're giving up your extrinsic value. So this is also why it's not a scary thing to be assigned. And also keep in mind, it's usually the ones that are closer to the money. Let me clear this off of here. Let me go back to we're going to get into that. So here's an example of this. If I'm long, let's say AMD is trading at $20, or you have a $20 call strike price, but the stock AMD the underlying stock is valued at $25 a share. The value in the option is worth $5. That is the intrinsic value. Intrinsic is value that has nothing to do with time or theta. Or I'm sorry, it has nothing to do with time, which is also theta. Awesome, I got some replies. So think of it like that. To calculate that, call would be the share price minus the strike price equals intrinsic value. Put is the strike price minus the share price equals intrinsic value. Okay. The extrinsic value and options are the time slash theta, which we're going to get into in a second. Time and volatility component, all the variables that could happen if you hold the option. Okay. So if I'm holding an option, so let's say I buy an option contract, and like we were saying in our example, let's say I bought one of these option contracts at the money, which is these 338, the 21st 338 strike. The component of that is, imagine this, as we get closer to the day, and the reason why I have two of these up here, I'm going to do this. So right here, I'm going to look at the 338, and so we're going to put it up like this. I'm going to say these 338s. I just want you to focus on this really quick. And then down here, I'm also going to do the 338s. I'm going to highlight it on the screen. Can you guys see that okay? Or do you have to really squint your eyes? I really hope you guys can see it. We will have basic Greeks today and more. Yeah, we're going to go over basic Greeks. I'm going to go over some of them, not all of them. So 338s, this is the way the options kind of work, is that you can see how the extrinsic value in these at the monies is 1.785 extrinsic value. That's price and time, and in time slash theta, also IV, but I won't get into that. 1.78 extrinsic value. And then if you go down here, you see 6.295. Do you see the difference in values? This is the 1.78 because it expires sooner. It expires on the 21st of August. If you look at this one down here, its intrinsic value is 6.29. But this one doesn't expire until September. So can you see why this one's value is more? And think of it like this, and we'll get into the theta aspect of it, but think of it like this, and that's what I really should have pulled a picture up of. If you get into, imagine this, if I did this, imagine this as being in time, and then I put this is in price. As an option contract gets closer to the expiration date, which is time, as it gets closer to it, it loses value faster and faster and faster. Okay. Let me go back to break-even price. At expiration, the option will be only worth the intrinsic value. Does that make sense? I'll say it one more time. At expiration, so if you let an option contract run all the way, if you let an option contract go all the way till expiration, and it goes into the money, even if it's by 0.01 penny, and it's now in the money, meaning if Friday it expires, it closes on Friday at the end of the day, it's in the money and it closes, and let's say you don't close that position, which, to be honest, your broker will probably close it for you. But let's just say, you had the 100 shares, or if you were selling the option, let's say you had the 100 shares in your account, or if you were buying an option, but usually that will happen with your broker and you will have those discussions. You should know what those discussions are beforehand. But if you're not aware of that, it will be exercised if it gets into the money, even by 1 penny. The option will only be worth the intrinsic value. Now, for those of you who've been trading options for a while, you might know this, you might not know this, but this will make you really think about it. Again, so if you're holding this option right here, and let's say come Friday, or let's say by August 21st, you're coming into that expiration date, the value, the extrinsic value will be lost out of the option contract once it's filled, right? So all you will be left with is the intrinsic value. For those of you who sell options, keep this in mind. It's not likely that any time before your option's expiration date, it's not likely that somebody, meaning the person who you bought the option from, or that you sold the option to, the person you sold the option to is most likely not going to close the order. They're not going to exercise the contract because they'll be losing money. They will lose the intrinsic value multiplier of 100. So keep that in mind when you're trading these, as far as being how close are you to being in the money, how far deep are you in the money, because these ones up here are more likely to get closed before the ones that are closer to at the money, if that makes sense. I hope I didn't really give you a tongue twister there. We'll get into that in a second too. If there is value at expiration. Okay, in the money, at the money, out of the money. Okay, in the money, out of the money, and then the last one is at. And this actually gets applied for all the way over here. Now, I'm not saying for this, in this particular case, I'm not saying it's either one of these. What I'm saying is it could be either whatever strike price is closest to the, let's say the share price is at $337. Let's say the share price is right here directly in the middle of the strike price of 337 and another strike price of 338. They're both technically at the money. In the money are options that right now are, the options themselves are either, they could be deeper in the money or they could be, closer to at the money, but they are profitable with, as far as intrinsic value goes. Out of the money, there is no intrinsic value at all, and it's all extrinsic value. Their only worth is the other variables aside from, if you close the contract right now, what it would be worth. Well, it wouldn't really be worth anything because the only thing that would be left would be the $0. So keep that in mind. I hope that really didn't make sense. I really just wanted to explain as far as like what is in the money. For puts, it's the other way around. For puts, you have contracts that are out of the money because the put strike price, the ones that are in the money, the strike price is below, or the strike price is above the actual put. Or is above the share price, so that makes sense. So let me go back here. So in the money, at the money, out of the money, volume. The volume is the number of contracts traded. Open interest. The open interest is how many contracts are currently open. So I'm going to go back to my charts. That's intrinsic, extrinsic. Now let me go back to my volume open interest. Okay. And by the way, you can set this up however you want. I usually have mine like this. I don't want to confuse you just yet, but this is how I have mine set up. We'll get into my list in a second. Volume and open interest. So the volume, which is this right here, and then you have open interest. The volume are the number of shares traded. The open interest are number of shares that are current, or number of contracts that are currently being held. This gives you a good idea of the liquidity of the stock that you're trading. So one of you guys in the chat right now, why don't you call out a stock that's, excuse me, you know what? It might take, there's a 20 second delay. So I'm going to do this. I'm going to go to NEO just because here's an example of this. So NEO is we know about this name. We know about the name because of the EV. But just looking at this really quick, you can see the difference already. If I go to a company like NEO and I look at the volume and then I look at the open interest compared to that of the S&P 500 or any other broad market stocks that there are, you're going to see less. You should see less volume and open interest because it's a less liquid stock. You know what? I don't have to pick on NEO actually. Let's do this. Let's go to let's see here. Let's go to Caterpillar. See it right off the bat, just looking at this. Do you see the differences with something like the S&P 500? I mean, even NEO had more than the CAT. But look at look how many there are. They're between 14 and 373. And then for the open interest, you've only got 282 contracts that are floating out there that aren't closed positions. comparatively to the SPY, that's not a lot. So what this also means, and I'm going to get it since we're on the screen here, we're going to get into bid and ask. And so the bid, you see 246, the asking price, you see 267. That's a pretty wide bid and ask as compared to the S&P 500, where it's like a couple cents, or that tells you that the spreads are wider. You've got to be careful when you're actually going in and entering these trades, because if you buy an option at the ask, you're talking about $267 versus $246, especially if you're buying multiples of contracts. You might not get a good fill. You might be buying something that not a lot of people have on the market, or there's not a lot of contracts that are traded each day. So be mindful when you're purchasing contracts. This is something you want to look at, is the volume, open interest, bid, and ask, in my opinion. Does that all make sense? You're paying more. So now I'm going to get into the Greeks, and yeah, for S&P 500, you have a lot more, things are a lot more liquid in the S&P 500. And even GLD, if I go to something like GLD, and we like precious metals, right? So I'm going to go to GLD. You'll see kind of the same thing for GLD. You're going to see the volume in open interest is pretty big. 3,870 contracts traded that day, which I believe this was Friday's. So that's how many were traded that day. And then open interest, you have 3,600 people who haven't closed that position, or 1,304 who haven't closed the position. Now let's look at silver, which is picking up, especially since the moves lately. So silver 8,000, and then you have 18,000. Part of the differences also is because silver is a little bit cheaper as far as the bid and the ask. But look at this spread. This is a good example of a pretty liquid stock. Is the asking or the bidding price is 70 cents, which is $70. The asking price is 72 cents, which is $72. So to get filled on a contract, if you wanted to purchase this, you're actually spending, there's only a $2 difference between the bid and the ask, if that makes sense, or a 2-cent difference between the bid and the ask. Okay, let's go back here. So I'm going to go into the Greeks. So the Greeks, theta is always negative, and the reason why it's negative is because it's deducted from your contract price every single day. Theta works against you. In options, theta always works against you. Well, not always. If you are trading spreads, that's something different, or if you are selling options, that's something a little bit different. But as an option buyer, that's a bad thing. Theta is not good. Depending on how you're positioned in a trade, money lost daily, it's time decay, right? Because if an option gets to its expiration date, let's say an option finally gets to, let's say, the 21st of August, just so you guys know, and this is why options is, why it can be extremely risky, is because these options here and these options here, if they don't come within the strike price range, if they don't close that day strike price range, they're worthless, right? So time works against you, in whether you're, whatever kind of option you're buying, time is working against you. As a stock, somebody who trades stocks, you can think of it like this. If I buy 100 shares of Apple, I'm going to own those 100 shares. So let's say I could withstand a market crash, and I can still profit on it, if that makes sense. But if I'm holding one contract, I'm not only betting on the value of that contract going up, and the underlying, which is the stock, I'm betting the stock is going to go up, but I'm also saying the strike price or the stock price is going to go above. If I'm buying this, $25 call, what I'm saying is, I'm saying that the option price is going to go above $25, but not just that, I'm saying it's going to happen by August 21st, if that makes sense. So theta is always the negative number. It's always working against you. So let's go back to our layouts here. Okay, now I'm going to get into the Greeks. Theta is that figure that's always working against you, okay? And the reason why, like up here, you'll notice theta is -3. And as you get closer to the money, theta will turn into 0.08, 0.08, and then it'll start going away to the downside again. And the reason why is because these middle contracts, there's a wider range. I'm going to get into we're going to get into probabilities in a little bit. I'll talk to you guys about that. As you get further in the money, they become less important to that contract because that contract's already going to move slow. They move slower. And so the curve on it moves a little bit slower. You'll notice over here on puts, it's still theta, negative number. It's the same principle. So as you can see, if you're an option buyer, you have that working against you, okay? Okay, delta is the price movement in an option for a 1-point move in the underlying stock. So when I'm trading, I also want to know the delta, and I'll give a example of this a little bit later. I'm going to do this. Put these over here for the puts. So on the left, again, we have the calls. On the right, we have the puts. Down the middle, we have the strikes and expiration date. And so just looking over here on the left-hand side of the screen, I see delta 92.92, which is $92. As you get closer to at the money, it becomes 0.53, which is $53. And as you go lower to way out of the money, so for those of you who like buying contracts because they're cheap, way out of the money, there's a reason why they're cheap, because the probabilities are not very high that it's going to hit, you know, 27.50. If you're looking at the silver contract, silver's not going to go above 27.50 by August 21st. I mean, I'm not saying that's not going to. The probabilities are less than if you were somewhere up top, something that's in the money or at the money, or, you know, you can be a little bit speculative. It's okay to get a little bit speculative on these and look at ones that are a little bit closer. And not only that, you're going to get paid more for them. It's going to give you 38 cents or $38 or $29 as opposed to $14 and $11. Just looking at the delta. But also keep in mind, you're going to spend a little bit more on time. You're going to spend a little bit more. You're going to lose $7. I'm sorry, you're going to lose, like if this is paying $36, you're going to lose $7 a day on, you know, on theta itself. Oops, okay. So let's go back to, so keep that in mind, delta is the amount of money that you're going to bring in. Again, delta over here, the reason why it's negative is because you're buying puts. So it is represented in price movement of the underlying stock. So if my stock goes from $23 to $24, if you own a put, you're going to lose 47, if that makes sense. If you are the put holder, you're going to lose the 47 cents. If you are a call buyer, you're going to gain the 53 cents. Now, if price goes from $24 down to $23, you're going to gain $47 instead of lose it. So let's do this. Go back here. So that's delta. Hope that answers the question about delta. Gamma is the rate of change for delta. Delta and gamma always moving. Remember that. Delta and gamma always moving. And it's the rate of change for delta. So if I go over here and I look at, do I even have gamma? So, you know what? I think I'm going to stop right there because I could keep going into the Greeks. But think of it like this. Gamma is the rate of change for delta. So it would add on to that $53. So to finish that thought, if gamma is at 18, it would add on to the $44 for the next move. So each dollar that the underlying stock will move, gamma will add on to the delta, if that makes sense. Vega, think of it as volatility. I'm not going to get into Vega or Rho. Implied volatility. Was that it for our fun pictures here? Oh, I'll go to this fun one and then we'll go back to the charts. So if and again, you can flip through when we're done here, we can flip through, we can actually go through. And by the way, I'm going to keep this to, I wanted to finish this up at 6 o'clock, but since we ran a little bit late, I'm going to go to like 6:10-ish, maybe 6:15. But So think of it like this and if you have any questions, again, ask in the comment section, and our friends in the comment section will be able to answer those questions, hopefully. Think of it like this. So if you are long a call, it's the right to buy a stock. If you are long a put, it's the right to sell a stock. And this could get a little bit confusing, but think of it like this. If I buy a put and it becomes in the money, it means I can sell the stock for that strike price at a later date. Think of it like that. But I'm long the put. But for us option buyers, it also means that I'm going to profit if I'm trading a contract in itself. Short, obligation to sell the stock. You are forced to sell the stock if you are assigned. Obligation to buy the stock. If I'm a put, if I have a put or if I sell a put, I have an obligation to buy a stock. If you're a put buyer, you're not obligated to buy a stock. What else do we have here for? I got the foundation. Okay, let's go back to implied volatility is the expected range of a stock's future price changes. Changes in IV come from option price changes. Remember that. It's not a set thing. It's like the reason where we get implied volatility. If I go to my screen here, and if I go to charts, and I'm looking at a chart and I keep implied volatility on my screen, but you don't have to do this. You could go, you also have historical volatility. Some traders use different indicators. The reason why I like to look at this is because I want to know roughly what are the contracts trading at. You're going to spend more money for implied volatility, and we're going to go over some examples pretty soon, but that's like, for instance, if people who are buying in this down here, if you're buying an option contract down in this range down here, you're going to spend a lot less money on premium than buying options up in this area, because and I'm going to go over the yearly ratio on how it is to determine whether a stock is, what the range is a stock can move within a year. I'm going to go over that. But for now, think of it like this. In low volatility times, if you notice down here, the volatility is less. Once you get high volatility, whether you're buying a call or a put, you're going to spend a lot more money. So think of it like this. If you believe silver is going to go up, would now be the best time to buy naked calls? This will answer that question, because if you're wrong, it's really going to hurt because you spent a lot of money on that contract versus if you bought it down here in this price area down here. When I don't even remember when this was. This is, I can't see the dates. Between June and July. Be careful trading options in high volatility times, in my opinion. All in my opinion. So option prices increase will mean higher IV and larger expected moves. I'm going to get into that in a minute. Option prices decrease will mean lower IV and smaller movements. We're also not doing spreads tonight, but this is a good example of like, do I want to be a premium? Premium means, it's the amount of money I'm spending on an option. Do I want to be a premium buyer in high volatility times, or do I want to be a premium seller in high volatility times? That's something to consider. Covered calls. I did put this on here because a lot of traders do use covered calls, so I wanted this to be on here. It's to reduce the loss. The covered call is a type of position that you can take. And this is what I meant with when you're trading options. What kind of foundation do we want to have? Because it's better to own stock, something that's not going to go away. Yeah, the value might decrease, but you own it. You own a share of that company. And you don't have an expiration date on it. So let's add 100 shares of AMD and it's trading at $25 a share. I could get a covered call that I'm going to sell a call contract. I'm going to sell a call for a, let's say a $35 strike price. Now think of this though. I have to own the 100 shares of stock, and then I have to sell one call against those shares. Entering into a covered call position gives up any profit potential above the covered call strike price. So let's say I'm super bullish AMD. Do I really, let's go to AMD chart really quick. If I'm super bullish AMD, and let's say I purchased AMD, let's say I did this. Let's say I purchased AMD anywhere over here. Let's say I purchased the shares. I bought 100 shares of AMD at $52. And let's just say $50. Let's call it $50. I bought 100 shares of AMD at $50. I then sell a $66 call. And let's say the expiration date is on 8/6. You've now given up close to this amount of profit on underlying shares. Well, you made it in shares, but you lost it in selling the covered call. You have options you have some options when you're trading covered calls, but it's very lucrative if you own the shares. It's less risky and it can be lucrative, especially if the share prices stay underneath 66.21. It's a way to sell the premium. Okay. Let's go back to. Okay, now hopefully, hopefully this isn't going to make anyone's head hurt. I'm going to try to do this. We have graphs for this now. I just want you to see how this is actually done here. So you have probabilities, which in options, I don't know if you've ever heard the words standard deviation. Now, I'm going to go into a picture of it here. A lot of this is irrelevant. I just want you to see, you really got to know this number here, which is 68% roughly. And then you talk about the 1 standard deviation, 2 standard deviations. It's the probability measured move in a stock within a year or within a time frame. Okay. Let me go back to our little. So stock price plus the stock price multiplied by IV. Okay. So here's an example. And for those of you who are trading Tesla, well, actually, let me do this. How many of you guys have traded Tesla in the last 4 months? Just put a 1. Put a 1 if you've traded Tesla in the past 4 months. And I'm going to start it off because I've traded Tesla I've traded a lot in the last few months. So we'll wait for some replies to come in here. This is an example of what I mean of like, do we really want to be buyers of premium in high volatility times? And this will really, if you really wrap your head around this part of the options course, this is where what loses a lot of people in options. And this is one of the most important, not the most important, but it's one of the most important things to understand. Yeah, put a 0 if you haven't, put a 1 if you have. You know what? Honestly, we could go with a lot of anything that's volatile, really. But this will really make you think of it because we really want to be a part of this because the moves in Tesla. Let me go to Tesla. The moves in Tesla are quite extreme. It doesn't look like it on the chart, right? Let me do a 3-year. The moves in Tesla are quite extreme. Do you want to see what Tesla normal range looks like? This is Tesla normal, right? This is Tesla on drugs. Okay, this is normal volatility on the blue. Yellow is what we are faced with right now. Now, for those, some of us actually love volatility. We love to play off of it because we can make a lot of money. But for traders who are new to the markets, it might not be so easy trading something that looks like an EKG machine might not be so easy. Let's look at some examples. So just looking at this really quick here, Tesla, on Friday, it was $1,650.71. Okay. So I'm going to say the equation again. It's stock price plus the stock price multiplied by IV. The implied volatility for Tesla for Friday was 76%, which gives us an answer of 1,254.54. That also is saying that the 1-year expected range for Tesla, think of this for a minute. If you really think about this for a minute, Tesla's expected range is $396 for the share, a share price, through $2,905 within 1 year. The probabilities is what? It gives us an IV of 68% probability. to be within that range. That's such a wide range for a stock. That's why it's very risky. So I'm going to go into the next one, which is Google. Google, $1,500 a share. And I picked Google because it was close to our Tesla price of $1,650. Google has an IV of 23%. That equals $346.78. 1 year expected range, $1,160.95 through $1,854.78 or and 51 cents. So you can see right now the curve, if I go back to the curve, is a little bit different. So the curve, you're watching this curve. Well, now I got 17 colors going on here. So the curve on a 1 standard deviation, it's got a 68% probability of staying within this range. Why is this something I need to know in options? Right? Why do I want to know I mean, who cares what the probability is? You know, stocks only go up. It's within that range. It's in the realm of possibilities that in statistics, it's the 68% range. Okay. Now, this could be good for something if you're trading on the 1 month time frame and you want to know what the probabilities of a stock are going to go. Let's say I'm trading a stock that's $15, and what are the probabilities that stock is going to go to $30 this month? Why does this apply? Why does this apply? And I'm going to go back to my chart here. I'm going to go back to AMD. I'm going to purchase AMD, and I go back to the trade. I'm gonna come down here and I'm gonna get a 21st of August $83. No, I'm not gonna do that. I'm gonna go down here and I'm gonna buy a August 21st $85 put or $85 call. You know, it only costs $85. $86 is the mark. And so when I'm looking at this, do I really want, and it's going to pay me $26 delta, right? It's going to cost me $15 a day to hold. Is this something that I want to buy? You know, and I go back to my chart and I look at, I might have just given you guys a wrong number on one of those, but anyway, if I go back to that curve and I'm looking at it, it's going to give me the probabilities, you know, and I can show you guys in the chart here in a second. I just wanted you to see this visually on your screen. It's in the 80%, the 68.2% range of being within that curve. Okay. That's why this is important. IV Recep's 1 standard deviation of 68% probability range for Tesla is plus or minus $1,254. In Google, it's only plus or minus $346. Let me ask you guys, give me a number one if you think, what is, as far as investment goes and options, do you think it would be safer to trade Tesla? Give me one. Or do you think it'd be safer to trade Google? Give me a two. And there's no wrong answer. I'm just asking what you would think. I know what I would do. Excuse me while I drink out of my fucking rain here. So okay, to find an expected range for 30 days. Yeah. And so I personally think it's less risky to be trading Google than Tesla. However, it's about risk versus reward. You can make a lot of money trading Tesla compared to Google, Google might not have the type of movement that Tesla does. But if you're wrong, it's really going to hurt compared to if you're wrong with Google. Square root. Okay, so to find the expected range for 30-day cycle, like I said, if you want to get something within 30 days, square root of 30 over 365 equals, I've already did the math for you guys, so I didn't want to trip anybody out with this math. I just want to show you, for those of you who want to skip this part, go ahead and skip it, but square root of 30 over 365, 0.286. And this is just the background. You don't really have to do this for every time you want to trade an option. I just wanted you to see these numbers. The reason why we didn't have a square root before is because it was a factor of 1, or because we did 365 over 365, so we didn't need to actually know because there was a 1 and it wasn't a, this is for finding a 30-day instead of a year. So Tesla, 1650, 71 times 76% IV, times that by the square root of 30, or the square root of 30 over 365, is a expected range Tesla 358.79. This might, you might get to a point here where you're going to say, oh, this is what he's talking about. So let me go to Tesla. Let me go back into here. Actually, let's do the chart. Let's go to the chart of Tesla. It might be easier to see. So, drawing, I just want to clear these. What? Okay. So just to give you an idea, I'm going to go to the daily chart. I'm going to zoom into Tesla. And think of it like this. What did we say our figures were? So we said a plus or minus 358 within 30 days. Remember that 30 days plus or minus 358 on Tesla, because this is the example we're using. Okay, so 358 plus the share price. I mean, 1650. So it's going to give us a price like this. I don't know. I'm just putting the lines on here. It's pretty wide. In 30 days, within 30 days, this is the 68% probabilities that it will stay inside this range within 30 days. So if you're buying a strike price that's at $2,700, expiration 30 days out, what's the likelihood it's going to get up there? And is it worth that? Is it worth the premium that you're going to spend? The high IV, is it worth that premium? Now, this isn't for scalpers. This isn't for people who are swinging it for one day. I'm just talking in terms of if you're going to purchase an option and you're going to hold it for 30 days, would a high IV stock be worth it to trade that for the amount you're going to spend? Something to consider. I'm not saying there's a wrong answer or it's just something to consider. For Google, that price is $99, plus or minus $99. Hey, and for those of you who are trading shares and you really want to know what option traders think of a stock, if you want to purchase AMD, and I just use AMD because a lot of people trade it, I trade it. So just looking at AMD, if AMD is trading at $75 a share, and you want to know what option traders think, if you go look at an option chain and you look at the IV, and then you look at the curve on where you think the stock will be, what the probabilities of where it will be, you can see where option traders are placing their bets on a stock. And you can see, like, okay, 90% of option traders are betting that it's going to be at $100 within a month. So I'm going to buy 100 shares of AMD. I'm not saying do that. Be careful with doing that because option traders are wrong a lot of the time. Option traders are wrong, so be careful. So be careful with doing that. And to find expected range for one day, same scenario applies, except for this time it's 1 over 365, which is 0.052. Gives you a Tesla expected range, 68% probability. 68% of probability. To be above would be 65, $65, let's say, above the share price of where it's at right now. So that's when people say, you might hear people talk about this. You might hear, oh, I'm buying 2 standard deviations away from the price, or I'm buying 3 standard deviations away from the price. And you have to be careful. You have to ask yourself, do I really want to be buying that far away from the expected probabilities wise? Do I want to trade outside of probabilities? Now, this is different for everyone's trading plan. We talked about this in the beginning. Some people's trading plan can justify that kind of move or that kind of price action. Some people's trading plan can. I'll be honest, in my trading plan, I do go outside of the 1 standard deviation. You can get pretty good deals, depending on what you're buying. What I'm saying is buying and holding an option until expiration date is what I'm talking about. That can be very risky. So, which goes into the next thing. Goes into the next thing. Buying or selling options. Do I want to be a buyer or do I want to be a seller of options? Okay. Option buying has more reward. Think of this, guys. You have unlimited risk. Or I'm sorry, it's unlimited in theory, unlimited reward in theory, compared to risk. But think of this. Can you guys see this? Less than 50% probability to profit by expiration. Being an option buyer. Remember that. We're less than 50% probability to profit by expiration. You need a move in underlying stock price and or IV. As an option buyer, I need a move in underlying stock price. I need AMD to go up. I also need IV. Okay, I need a move in IV. You can exercise the contract at any time. Risk is defined as a cost. The option costs you, which is the premium. You could lose all of it because you're an option buyer. You could lose all the premium, but it's only that. Think of that. The amount of money you spend on option, if you're buying the option, let's go back to our little. Okay. So as an option buyer, this premium right here, which is the bid and the ask, and I buy the call, or over here you have the bid and the ask, and I buy a put, that's the most amount of money. You can't lose any more than that if you're a buyer, right? If you're a seller, that's different. But as an option buyer, you can't lose more than what you pay. And the funny thing is when you're purchasing stock, guess what you can lose? If I buy AMD, what's the risk of buying AMD? What's the risk at buying AMD at $80 a share and I buy 100 shares? If AMD is trading at $100 a share and I buy 100, or is $80 a share and I buy 100 shares, what am I risking? What if the stock bankrupt tomorrow? AMD went out of business tomorrow. What would your shares be worth? So to be honest, technically speaking, buying one call is less risky than buying AMD in itself, in a sense. Now, I'm not trying to counter. I know I talked about the foundation earlier. We want to have a foundation because the likelihood of AMD going to zero tomorrow is like 0.0. You're more likely to get struck by lightning than AMD going to zero tomorrow, right? But remember that 50% probability of profit by expiration. The risk is defined as the cost the option cost you. It's the premium. Option selling. If you're an option seller, option selling involves more risk versus reward. Well, if there's more risk versus reward, why would we do it? If there's more risk versus reward, why would we do it? Why would we want to sell an option? Oh, this is why. But higher probability, greater than 50%. Now we know why banks sell options. Because they are more probable for them to profit. Even if the risk is a higher risk, it's more likely that they will profit more than 50% by expiration. Max profit is total premium paid to you. If I buy a call, go to our trade tab. If I buy a call $230, $240, I'm paying that to somebody, right? I'm paying that to a bank, or I'm paying it to another trader. I'm paying that to somebody. And if this goes out of the money and gets down into this zone down here, by expiration, I lose all of it. And guess who keeps it? The bank or the person who sold it to you. You do not need a move in stock price to make money if you're an option seller. You don't need a move in stock price to make money. Okay, the stock price could stay right where it's at and you can make money. You could be assigned shares at any point. If you're an option seller, you could be assigned shares at any point. Remember what we were saying before. What's the likelihood? Let me go to extrinsic versus intrinsic. Did I already go this one? Yeah, I did go this one. Okay, let's go to extrinsic versus intrinsic. There's no point for if you're close to this range. they're going to lose money on it, on the extrinsic value of the option. So why would they exercise? It wouldn't make sense that they would, you know. Risk. In theory, if a stock goes to zero, you are liable for 100 shares times the strike price as an option seller. However, you keep the premium paid to you and weigh the differences. If we had to be an option seller, option buyer, I want to really emphasize people who are new and they want to sell premium, which is option selling is also known as selling premium, and you're not using a spread. I want to say it again, be very, very careful, because we see a lot of stuff in the news about people owing their brokers $100,000 or $500,000 and bad things happen and it's unfortunate, and you know, or they just don't know what they're doing. If you want to stay away from those, you just got to be really careful. I'm not saying that those things will happen. I don't mean to be a fear mongering or whatever. I'm just saying, like, you don't have those risks when you're buying options, okay? When you're selling the options and you don't know what you're doing, especially if it's like right before X dividend date and you're holding it, you got to be careful. When to take profit. When I'm buying, when we are in a position, how many of you guys right now have this issue with I don't know when to take profit? Say I in the thing if you don't know when to take profit, just say I don't, or just say I. So buying, when we are positive in a trade, do we hold for more gains when I'm positive? What do they say, diamond hands? Super? Do they say diamond hands? There are some people's contracts I see sometimes when they bought it in March and they're up $100,000 on the one contract or whatever insane gain, and they're still holding it. You know, they're still holding the option. How much juice are we trying to squeeze out of the lemon? How much juice are we trying to squeeze out of the orange? You know, there is a curve to this. There is a curve to it in your charts, and I'm not going to go into it for Thinkorswim, but you can go in here. You can go in here and adjust your. If I go to, and I just said I wouldn't do it, but you could go in here and you could look at different curves, and you can change to. If you go down here and change this to, you go down here and you can play with these a little bit. There's things you can do in every program. I don't know what you guys use, but there's different things we could use. And you can look at the curve, and you could also look at the probabilities. This is that crazy put you guys to sleep with my math. You know, there's different ways you could to do risk profiles on different types of options, but I don't want to get into that because some people don't use Thinkorswim. And so as far as like, do we know when to sell an option? There is curve to it. There's a theta curve. There's different curves with the different options. So you can actually load into those programs like what options you're actually trading. Because there's a certain time that passes where it's like the option price isn't going to gain any more value. In fact, now you're losing money every day just because of the theta. The option itself isn't gaining value. You begin to need crazier and crazier moves. When I'm selling an option, when we are positive in a trade, it makes sense to close the position as your risk is heavier than your remaining reward. Well, wait a minute. And honestly, this could be for when you are purchasing a option. To be honest with you, if you're down money, like, actually I'll get into that, but let's just say this. For selling, that's what it is for selling. It makes sense. When we are positive in a trade, it makes sense to close the position as your risk is heavier than your remaining reward. Be careful with option selling. Again, for the 5th time. Okay, holding a losing position. Buying. The closer the option gets to 0, the less you have to lose. But the more reward possible. In theory, does it make sense to hold a losing trade? You got to be careful with this. For everyone, it's different. For mine, I don't want to hold an option if it's more than 50%. If I'm down more than 50, if I'm down 50%, I don't like that. To be honest with you, I'll close an option if I'm down 20% because I don't like the way the chart looks and I know it's just going to lose money every day. So for me, my trading plan, I don't personally I do use stop losses, but this is why a lot of option traders won't use stop losses, is because if you think about it like this, I'm going to do this. If I spent $400 on the call, okay, and let's say I lost out of that $400, let's say I only have $100 left. That means in theory, the risk is $100, but I bought this call. So what's the upside potential? I bought a call, so the upside potential is technically unlimited. It's unlimited upside potential. So technically speaking, the reward, it way outweighs the risk that's remaining. But like I said, for me, I don't like doing that. I would rather cut my losses way sooner than that. You want to give it its time to run, and you want to give it the room that it needs. But you also, I don't want to be 60%, negative 60% in a trade. Unless I have a bunch of other option trades going that day where I'm up like a tremendous, I'm up a lot more in other trades. Selling with negative, it's easier to close a position because you have a lot to lose compared to the reward amount available. If you're selling a position, you have way more to lose, right? Compared to the reward amount that's left over. Should I be nervous about assignment? Well, so I just saw one comment. I don't know when it's enough profit. That's the thing is I use support and resistance on an actual chart. I go in here and I'm in the monitor. If I go in here, I'm actually looking at the support and resistance levels. I'm going off the chart, the underlying stock. But also, when you get to trading stocks longer, you'll start to be able to see these things, and you'll start to be able to adjust as you go, which would bring me to another point. Be careful about buying too many options. Be careful about averaging down. That could be a huge mistake to average down. If you don't know what you're doing, it could be very costly, especially depending on the strike price and the expiration date. There's so many variables that go into options, but there are resources on your trading platform that you can use to measure some of these things, to measure the probabilities, to measure to measure the sorts of things where you'll be at as far as the money wise, how much profit or loss at certain dates or certain prices. So for me, I go off of this. If we have, we gapped up one day, or let's say we had a breakout and a back test and I bought a call, I'm using the chart itself to take profit in the option, if that makes sense. Should I be nervous about assignment? If option closes the expiration day in the money, it will automatically be exercised. We talked about that before a little bit. So be careful when you're holding close to expiration. When an option buyer exercises an option, it will lose all of its extrinsic value. Remember, we talked about that. Extrinsic value. Part of the option pricing when you're paying the premium is you're paying for the intrinsic. Oops. You're paying for the intrinsic and extrinsic values. Okay, that's part of an options pricing. So at expiration, when somebody exercises the contract, it's automatically going to lose. You're giving up your extrinsic value, which brings me to the third point. Do you ever really want to exercise a contract? For this one contract, it's going to cost you $95 just to exercise the contract. You might as well just go buy shares at that point. Do the math, you'll see a lot of times it's cheaper just to go buy the shares. Okay, so I'm going to go back to when an option buyer, okay, we talked about that. Options that are further in the money have a higher probability of being exercised because they have less extrinsic value, and it would make more sense these to be exercised compared to options barely in the money. We talked about that. If you are holding an option, don't be too worried about the options that are, well, especially the ones that are, let's do this. Especially the ones that are closer to, like these ones down here, that are closer to at the money. They're less likely to be exercised than these up here. Why would anyone, you're giving up the value up at the top when you're further in the money. They already have less extrinsic value, so it makes more sense that those would be exercised first. So Can I set a? I'm just reading through one of the comments. Can I set a sell limit or stop loss according to the underlying stock price? I don't. I just look at the. I use psychological. I mean, I manage my trades live, so I'm not like, you know. Well, for one, I'm a little bit confident in some of my trades. I'm not too worried about it, but I'm watching the trades all day anyway, or I'm glancing over them every like, maybe every hour of the day. Know the names you are trading. There is a higher probability to being assigned if you are short selling a call option. If you're short or selling a call option that is in the money and has less extrinsic value than the dividend before a stock's ex dividend date. Okay, so if you're selling or you're short, if you're selling these up here, or you're short, if it's before an ex dividend date, you better be careful, because if the extrinsic value is less than the ex dividends date, is less than the dividend, you have to be careful, because they're more likely to be exercised. So you better be careful. And if you are trading it, just know what names you're trading. And I'm talking about strictly for people who are selling options. To summarize the nervous feelings, in my opinion, it is safer when you are new to stick with buying options instead of selling them for the above reasons. I'm not trying to scare anybody from selling options. I'm just putting that all out there. You have more rights as a buyer than you do when you're selling. And the last thing I want to get into, and actually I just want to make sure we covered everything I wanted to cover, or I'm kind of running out of time. I wanted to, so just looking at this, I want to make sure everyone has this down. Intrinsic, extrinsic, the bid and the ask. I'll go into mine really quick. If you guys want to see how I do it, how I have mine set up. And here's the thing, and this isn't going to answer all the questions you guys had. Like, you guys will continue working on these things. So the net change, how much it changed, or the net change, just like a stock's net changed. I like to look at the volume, the open interest. I like to know the last price, and I try to beat that a little bit if I can. If I'm entering my orders, I'll try to beat the last price. Mark. So for those of you who don't know what mark is, it's the price in between the bid and the ask. So let's say I want to buy an option contract down here at, down in this, closer to at the money, and I want to know, like, let's say the spread right here, you see the spread is 230, 240. Mark is the price in between, so I'll try to do the mark plus a couple pennies, or mark minus a couple pennies, if that makes sense. And that's why I have it on my chart. And like I said, delta is the price, so you have $46 you'll make if the underlying stock moves $1, if it goes from 80 to 81 cents, or I'm sorry, if it goes from 80 to $81, you will have 53, like this one anyway, you'll have $53 is what it would pay you. The theta is $19 in time. The bid and the ask, of course, is the same as stocks. It's the spread in between the askers and the bidders and the askers, or the sellers and the buyers. And then right here, of course, you have the strikes, or you have the expiration dates, and then you have the strikes. And since there's something else I wanted to show you guys, is just looking at the strikes in themselves. If I normally have it on all, because I want to see all of them on my charts. For purposes of this video, I turn all off, because I don't want to blind you guys with the screen full of confusing numbers. So just for purposes of this, I keep it on 14, just so you can kind of see. And then I'm not going to go into Thinkorswim, but if you guys ever have, not too much anyway, I love Thinkorswim for so many reasons. But if I can put up here the actual chart itself, so I can look at the chart, and then I can have the option itself. I can look at the option chain itself on an option that I choose, or I can look at the chart for an option I choose to see where its value is. And if I look at this right here, and I put these both on, I'm going to say on 1 day, 20 days, 1 hour, and I put this one on, I'll do the same thing. I'll say 1 year, 1 day. I'll put this on 1 year, 1 day. And as you can see, my cursor's lined up with the different, you can see where it's at on the chart above. See how I'm moving the cursor around? You can see what the actual option price was compared to the chart above. So if I choose an option down here, I can right click and go or I can go to send to, and I put it on purple. Whoops. Now I can look at this to see where it's actually at, and I think it's, let's do 5 days, 5 minutes, 5 days, 5 minutes. And I can actually look at this and it'll show me the price. So check this out. So as you can see, even on here alone, you can kind of look at what the option was doing one day, and then as we pushed to the next day, you can kind of see what it's doing. I hope you guys can kind of see that on my screen. You can see what the actual option is doing compared to the underlying stock, and you can see how it affects and how it's actually moving around on different screens. So I like using Thinkorswim. Is there anything I didn't go over? How do you get the option chart up there? So I'll answer that. I'll go ahead and answer that question. If there are any other questions, go ahead and post them now. I'm going to probably have to answer them off this video. But to answer that one last question, how do you get the option chart up there? You just go into this and you can choose the link. You can unlink it. You can link it. I do purple. Let me get this off the screen here. You can set the drawings on here. You can go to the quick chart. Oops. You can go to quick chart. You can add a thing up here, or if I can, down here, there's a little plus button and you can do quick chart. Whoops. You can go to quick chart and then it'll ask you which one you want. And then you can just link this to purple. And then I go over here to the chart, and then if I right click it, and I have this one up here linked to purple also, but I like to see it on the left hand side. And then you go to the option that you want, right click it, and then you just say send to purple, and it'll put it over here for you. This one's on red, and the reason why is because on AMD I have red attached to red up here. So if I went to S&P 500, if I go to SPY, it'll change this to SPY, but I can still look at my purple AMD. In fact, I can look at my AMD contract with the SPY overlay, if that makes sense. So I think that wraps it up. Oh, so normally on Sundays we do these every Sunday. Normally we do broad market analysis or individual stock analysis every Sunday. And by the way, feel free to hit the like button if you've gained value out of the stream. Hit the like button if you if it was something you enjoyed or you gained value out of it. Hit the subscribe button and then bell notification. That way when we do go live, you'll get the notification that we're live, or if we post any new videos. If you have any questions, comments, concerns, feel free to leave them in the comment section, and I will try to answer those as soon as possible. We will do a part 2 in the next options course. We're going to get into spreads and more in-depth options training. If you guys have also any more further questions on options or want to learn more about them, feel free to message me on Messenger / in the Discord. Message me on Discord and I will get back to you as soon as possible. I appreciate all of you guys being here. I appreciate your time. And we will see you hopefully next Sunday. We'll see you next Sunday, 5 p.m. Pacific Standard Time. We'll go over plays that you guys want to go over. Have a good night, guys.